sons and daughters or doctors or whatever now, like they don't have time to hire a new management company and, deal with all the rigmarole. So setting them up in stuff that can actually be, truly passive income, I think is an important part of estate planning.
The show Yellowstone, that's the whole concept. Kevin Costner, he's got the $100+ million land. Beth, his daughter's like, Dad, sell it, because if you die, the state's going to take it because it's inside the taxable estate. So talk about solutions or ways that you are informing or helping people to solve that. We think we have an amazing one we'll talk about here in a second, but I'm just kind of curious, what are you using to solve that challenge or help your clients prepare for that?
I don't know of too many super creative. I know people, usually involve their estate attorneys and set up certain trusts, and maybe they can gift a certain amount of property ahead of time. I'm dealing with a couple of situations where there was a generation skipping tax that was kind of created, where it skipped the first generation. And now it's up to the generation after to pay. So that's a way of deferring it even longer than the first generation GST. So that could be employed. But generally, this is also like before you die, like you got to make sure that you got enough equity or have a plan that somebody can actually offset some of those estate taxes, because, this is all just goes into like strategy ahead of time. Like, are your beneficiaries going to have the liquidity to pay estate tax? And if they don't, are they going to have the ability to refinance and keep some properties to pay that? Or, do we need to start selling some stuff early and, doing exchanges into stuff that the next generation will want to own? Like, I think it really involves a lot of, critical thinking. But I don't have a silver bullet on how to completely avoid estate tax. I think that there's some, insinuations with trust. You might know more than I do. But generally buying the right properties and exchanging and setting things up where they can actually be scaled by the next generation versus, burdened, like by an apartment building, for instance. Like most of these, sons and daughters or doctors or whatever now, like they don't have time to hire a new management company and, deal with all the rigmarole. So setting them up in stuff that can actually be, truly passive income, I think is an important part of estate planning.
Yeah, so let's geek out about a little bit, right? Okay, and this is literally the reason we formed Capital Gains Tax Solutions, because when I was at Marcus and Millichap after the '08 crash, I saw friends, family, and clients in Sacramento, is kind of a more boom bust city of California, lose half or everything. And the biggest thing we identified, Shaun, was that the 1031 exchange has its limits, right? And one of them being that you have to buy within 45 days, or identify in 45 days, buy within 180. And sometimes you're selling high and you're buying higher, right? With bad debt and deals that aren't necessarily value add. In other words, all of the freedom that you built up with this passive, real estate and or active real estate for your wealth and impact is now being challenged. And now we're seeing the same thing with this $84 trillion transfer in the next 20 years, known as the largest wealth transfer in the history of the planet. And the death tax is what needs to be solved for now. It's the big elephant in the room, and most of us have been focused on the tiger by the tail. And so here's what we do. We do what's called a deferred sales trust. Eliminates the estate tax in one day. Does take a sale, Shaun, right? So you need to sell the asset. So if someone had $100 million worth of apartment complexes in New York, they need to sell it before they die. Don't have to give it to charity. You don't have to do any gifting, and you don't have to do any life insurance, right? And so those have been the traditional methods where you have to try to gift to kids slowly, and you can only do so much per time. The GSTs, the General Shipping Trust, which can be a little bit inefficient as well. Ours is literally in one day, one sale, no life insurance, no gifting required, no charity required. Your children can be the beneficiaries, but we eliminate the estate tax forever. And so we just did a deal for a client. They're worth about $30 million, live in California. Okay. We're selling a $5 million multifamily property in Colorado. And for them, they looked at a 1031, but their basis was zero, their debt was zero. But the biggest thing was their estate overall valuation was large. And so they said, let's eliminate the estate tax right now. So we sold into the DST plus, eliminated that. And now the assets that are growing can be invested into passive real estate, active real estate, lending. You can put into T-bills. You can put in the stock market.
Are there other people that own the DST, or is it wholly owned by the beneficiaries of that sale?
Wholly owned by the beneficiaries they sell. Think of it kind of like an IRA or a 401k, or even like a mini 1031 exchange company, right? That's set up. And again, not to be confused with the Delaware Statutory Trust, which is the 1031 DST. This is a deferred sales trust. It's like a C corp that only does business with that family. And so for
Got it.
this particular one, it's the married couple while they're alive, and when they pass, their children are the beneficiaries. And so that's the DST plus. The DST 1.0 is a traditional installment sale that also only does business with that family. And so we set up individual EINs. It's like, individual trust that has its own EIN, has its own tax return. We have third-party money managers on it.
But
But the
hold on,
big
that would only work, right, if they had no mortgage, if the installment sale, right?
No, you can actually do it. We just pay off the debt, right? And
Okay.
so what we have to look at a couple factors. A, what's the adjusted basis? B, what's the debt? And C, what's the sales price? Now, if we have some debt over adjusted basis, Shaun, we're going to solve that by replacing that debt via a 1031 exchange, typically a Delaware statutory trust, which has like a zero coupon, 80% LTV, where all of the cash flow is paying off the debt. And so we'll replace that debt over the basis. If they don't have a debt over the basis, then it's just the difference on the sale. So if we just did a $13 million sale in San Diego, they had about $4 million of debt and about $8 million of equity, and they also had 4 partners. And this is also one of the challenges with the 1031. Typically, the whole entity must move, meaning everyone must go together, and that can be a challenge, right? In this scenario, one of the partners wanted to be cashed out. He was a minority partner. He just paid his tax. The other 3 did a DST. They paid off their debt, and they sat in conservative, 10% on average multifamily lending fund. And now they're going to be building other assets. And so, A, you don't have to replace the debt unless you do a 1031 exchange. Since we're not a 1031 exchange, we don't have to replace the debt. So we can be debt-free, diversified, unless you have debt over basis, but then we do a partial Delaware. So these are what we do. We take this a Rubik's Cube, and we love it. We geek out about solving problems for this exits. And as we do that, people get this freedom. And the best part is they get to sell high and buy low, right? They get to sell when it makes sense. And it eliminates that, hey, Shaun, I'd love to sell, but go find me that up leg. Or Shaun, hey, I'd love to sell, but I don't want to get stuck in a 1031 chasing it, or even that trophy asset that has that old depreciation schedule. One of the biggest challenges with the 1031 is the old depreciation schedule travels, which means essentially you're losing out on a big opportunity to offset that high tax flow or high tax rates in like in California and New York. Where our strategy, what's beautiful is we can sell that, let's say that $50 million asset on that corner that no one's ever going to sell because they're they're the dinosaur that only collects the real estate. You got to approach it with different solutions. And that solution is, hey, Mr. Dinosaur, estate tax is looming. How are you going to solve for that? And he goes, well, I've done some gifting. I've done some life insurance. Well, what if we could eliminate that $50 million estate tax right now by selling the asset and moving it out? And that's not 50, it'd be 40% on the 50 million. It won't be quite that much, but essentially get that outside the taxable estate. But also better than that, you can buy an asset with the trust. And this is the coolest part, Shaun. You can partner with the trust. It's a joint venture partnership. And in this scenario, you reset your depreciation schedule. So we had a client, and in fact, 2 clients, they sold 120 million worth of multifamily. And this multifamily, it was syndicated deals. So there was GP positions, but they took the money into the trust, their GP positions, which had an old depreciation schedule. And then they partnered with the trust with a new LLC that went to their new deals. And that gives them a new depreciation schedule, right?